In this video, I'm going to talk about how you can take your investment losses and potentially turn them into winners through something called tax loss harvesting. Stay tuned to learn more. Welcome back. This is episode 174. As we move into November and the end of 2023 gets closer, it's time again to talk about and think about tax loss selling or tax loss harvesting. So this week, I'm going to talk to you about how you can potentially turn some of your investment losers into this year's winners when it comes to tax planning. And if you're new to the show, my goal is to teach you how to save for retirement, how to plan for retirement, how to invest for retirement, and how to pay less taxes in retirement. And if you want more help on how to do all of this, then consider taking my comprehensive retirement planning course, Retirement Readiness Review. It's an online course where I will walk you through all the steps in planning and managing your perfect retirement. So to learn more, head over to retirewithryan.com/on-demand. Now, it would be nice if every investment you made went up every year. Unfortunately, that is never going to be the case, and timing also plays a big part in how your investments will do. If you look at the S&P 500, for example, which is the 500 largest stocks in the United States, since 1970, the S&P 500 has declined 11 out of those 53 years, resulting in negative returns. This means 20% of the time your portfolio was down in value. So there was a 20% chance that you could have made an investment in the S&P 500 at the beginning of the year and have it be worth less money than what you purchased that investment for at the beginning of the year. And that's just the average. It also depends on the time of year that you make your investment. And if you then own individual stocks or other funds that invest differently than the S&P 500 or invest in other indexes such as small cap index or international, then you could have even more deviation. So because of this, every year you should be watching your portfolio, watching the unrealized gains and losses to see if you have any investment losses that you can capitalize on and help reduce your current tax bill as well as your future tax bill. So you could use that loss as an opportunity also to reposition that investment into something that might do better or something also that might be more tax efficient over time. And to be clear, taking a tax loss only applies to an investment in money outside of retirement accounts. This isn't money that you're investing in your retirement accounts. So this is money outside that you're investing in some type of a investment brokerage account, or it could be just a mutual fund account. And any capital gains that you have on these investments, as well as any dividends or interest you receive on your taxable account, is taxable at the end of the year. You'll be getting a 1099 that would let you know any taxes that you owe. Now, if you've listened to past episodes on investing, you know that I'm a big believer in index-based investment strategies, meaning investing in index mutual funds, or even better, using exchange-traded funds, or as they're otherwise known as ETFs. You'll still need to pay tax on any dividends or interest that you receive from these funds as they're paid out, but you're unlikely to receive a capital gain distribution from these ETFs unless you choose to sell your ETF fund. Now, this is different from most actively managed mutual funds, where the objective of the actively managed mutual fund is to try and beat the market regardless of any tax consequences. So you could have to pay capital gains tax on your mutual funds each year, even if you didn't sell them. And you'd receive at the end of the year a 1099 showing that you had a capital gain distribution. Now, you may also have to pay capital gains taxes on these distributions in years where your mutual fund lost money, making this even worse. And you've probably experienced this if you've been investing in mutual funds in your taxable account over the years. And from a tax efficiency standpoint, index-based ETFs generate little to no capital gain on an annual basis, just based on the way that they're structured. And you would pay less tax over time by owning them as compared to an actively managed mutual fund. You'll still pay capital gains tax when you choose to sell your investments at a profit, but you'd have control over that and you wouldn't be getting these capital gain distributions throughout the year even if you didn't make a sell in your fund. So if you own one of these mutual funds that's an actively managed fund that is tax inefficient and is at a tax loss, meaning it's worth less in value than what you paid for it, now might be a good time to sell it and switch over to an index-based ETF fund. Or also, if you have a small capital gain on that actively managed fund, because this year the stock market is down from its highs in July, and some areas of the market are down even further, this could also be a good time to look at switching out of that actively managed fund. So how does tax harvesting work? Well, you sell the investment that is down in value from your purchase price. You can then use that loss to offset other taxable capital gains for the year, or you can write up to $3,000 of losses against your ordinary income for that year. And then you probably want to immediately reinvest that money so that once you sold it, you're not out of the market or out of the investment in case it comes back. So you can buy something similar, but it has to be different. Or you can buy that same investment and you can buy it, you have to wait 30 days to buy it back without canceling the loss through what's known as a wash sale. So let's just work through a couple examples of how this would work. You sold some investments that had a short-term capital gain of $20,000 this year. And based on a 30% tax rate, you would owe $6,000 in taxes if that was a short-term gain. Let's just say you have another investment that now has a loss of $25,000, but you haven't yet sold it. Well, you could sell that investment and you could use that $25,000 gain to offset the the $25,000 loss to offset the $20,000 gain, leaving you a loss of $5,000. And if you had no further gains for this year, you can then deduct up to $3,000 of that loss against your ordinary income tax for this year, and the remaining tax loss of $2,000 can be used to offset the gains the following year or taken as a deduction in the following year. A second example would be you have an investment that has a long-term capital loss of $15,000. You don't have any other gains for the year. You could sell that investment, then capitalizing on the loss, you'd be able to deduct $3,000 of that loss for this year, and then you'd carry the remaining loss, the $12,000, to use to offset future gains, or you could continue to write that $3,000 off until you fully exhausted the loss. So there's some factors that you want to consider before using tax loss harvesting. First, as I said earlier, tax loss harvesting can only be used in non-retirement accounts. So you can't do this in your 401k, your IRA, your Roth IRA, your SEP, your Simple, etc., any retirement account. Second, losses need to first offset like gains. Now, if you're not an accountant, that's okay. Your accountant will figure this out for you, or your accounting software will do it. But the way it works is that long-term losses are first applied against long-term gains, and short-term losses are then applied against short-term gains. And if there's any losses in one category, they can be applied against each other to offset those gains. Third, be aware of the wash sale rule that I mentioned earlier, which means that you can't sell an investment at a loss and buy a substantially identical investment within 30 days before or after the sale, or the loss is disallowed for that current income tax year. So now what that means is that you couldn't have bought that stock within 30 days and then sell it and capitalize on the loss. It would have to be outside of the 30 days. Unfortunately, the government has not provided a straightforward definition of what constitutes substantially identical. You just have to use your best judgment. For example, let's just say you were an investor in Pepsi beverage stock and you wanted to take a capital loss on that. Well, if you bought Coca-Cola stock, even though it's in the same industry, it's different enough that you could capitalize on the loss. If you were an investor in the home improvement sector and you owned Lowe's and you wanted to sell that and buy Home Depot, you'd also probably be fine. But let's just say you owned a Vanguard S&P 500 index fund and you were going to sell that and buy a Fidelity 500 index fund. Well, that is not different enough. That's too similar. But what you could do is you could sell the Vanguard S&P 500 index and you could buy a Vanguard Russell 1000 index. So that's a different index that's substantially different enough that you'd probably be okay. Or you could sell a large cap index and buy a small cap, or sell a large cap index and buy a total stock market index. Again, different enough. It has to be different. It can't be the similar index, or it could just be a different fund. As long as that fund is actively managed, it's probably going to be different enough that it's not going to be the same fund. So be aware also, last thing is that this applies across all your taxable accounts. So for example, if you sold one fund at Charles Schwab, but you bought it back within 30 days at Fidelity, you've then violated the wash rule because it applies to all your investments regardless of where they're held. And the IRS has ruled that Revenue Rule 2008-5, this is what this applies to, is a wash rule. So it also can't apply in your spouse's account as well. So you'll keep that in mind. And then options count too. So for example, if you sell an S&P 500 index ETF and then you buy an option on the S&P 500 within 30 days, that also creates a wash rule. So you want to do your homework and you want to look over your taxable investment accounts cost basis report. Usually this can be found online, and you want to do it probably there rather than your statement, so that's the most up to date. And this is in your taxable accounts. See if there's any losses and consider selling those investments and buying back something similar, or you could wait the 30 days and buy that identical investment back. I don't think that's a great idea because 30 days is a long time. A lot can happen in the markets, especially generally the markets tend to rally at the end of the year. I'd much rather see you sell that investment and buy something to take the loss, something different enough, but still gives you exposure to that similar investment. And this is also a great time to consolidate investments. Like if you have a lot of mutual funds and they have losses, you could consider consolidating them down and getting them down to just a couple ETFs or index funds. Or it's also a great time to switch from expensive mutual funds to ETFs that are generally much lower cost for savings that will go to your bottom line, as well as tax efficiency to help reduce the amount of capital gains taxes that you could potentially be paying on these investments as we go forward. So if you don't know what your mutual funds are costing you, consider going to Morningstar.com. It's a free website where you can get a lot of information on different investments and enter in your mutual fund symbol. From there, Morningstar will give you some free information. There's paid information as well, but usually you can get enough from the free information for what we're trying to do. And it will tell you what the expense ratio of that fund is. So if you don't know, the expense ratio is the annual cost of the fund that you're paying. Even though you don't see it, it's deducted from your fund every day, and you're paying for it over the course of the year. So let's just say you put in a mutual fund and it says you're paying 1% per year. You could switch to an index-based ETF and pay less than 0.1% per year. So that savings of almost 1% would go right to your bottom line and help you keep more of your money. This is why I'm such a fan, or one of the reasons I'm such a fan of index-based investing. And the second thing is that while you're on Morningstar.com, you should also look at the performance of your mutual fund. And I would suggest looking at the 3, the 5-year, the 10-year annual performance of your mutual fund and seeing how it's done against its comparable benchmark, which is essentially how that fund is measured. And if you see that that fund has significantly underperformed the benchmark, this is even further reason why I would suggest switching to an index-based ETF as an alternative or just as an overall strategy to your portfolio. So definitely some food for thought as far as how you can capitalize on some losses that you might have in your taxable accounts. And I hope you enjoyed this episode. And if you have a listener question and you'd like to have it considered for a future episode, head over to retirewithryan.com and click on Ask a Question to have your listener question proposed. And if you haven't subscribed to my YouTube channel, if you're listening on your favorite podcast app, please head over to YouTube and search Retire with Ryan Podcast and subscribe so that you can be notified when I post more videos and more information on how you can plan the best retirement. Have a great week, and I look forward to talking to you next Wednesday. Take care.